All right. Hello, everybody. Welcome to the morning live, or not morning live. It's the market close. You can see I just had some Subway here. Hope everybody's doing well. The Wi-Fi is being a little weird, so I'm sorry. The Wi-Fi, it'll get better in a second. The video probably sucks because the Wi-Fi is being weird. You should be able to hear me pretty well. Yes. Okay. You should be able to hear me pretty well. Ahad, what's up? Richard, Shintoki, the cows are back in town. Ring the bell. Cows are back in town. All right, so a lot of stuff has happened over the past 4 hours because, of course, so much stuff happens every single day within 9 a.m. to 4 p.m. Let me just tweet that I'm live right now. Did you listen to Ye on... Wait, Kanye West was on CNBC? No way. No way. Oh my goodness. He was. Where's the video of this? Oh boy, we got to see this. We got to see this. Kanye West, CNBC. Where's the video? He said he did an impromptu. If anyone has this link, send it in the chat right now. Oh my goodness. That must be so cool. Amit, why are you doing live streams closes now? I dig it. Got to keep working. Wow. Okay, so we'll get into the Kanye thing in a second. First, let's go to the market. Tesla has remained strong throughout the day. So if you are a Tesla bull, if you're a Tesla shareholder, you should be very happy. Tesla is somehow maintaining. The market overall has been pretty green today. It's not been horrible. But it's Tesla's been doing well. So Tesla's up. Palantir, we went above 8. We're at 797. By the way, if you're not following daily Palantir on Twitter, you absolutely should. I've been posting a lot of little 30-second clips of the Karp interviews on that Twitter account. So if you want to see Karp talk about hyper-specific things in depth, then you can check it out. NVIDIA below 130. Wow. NVIDIA below 130. NVIDIA is getting shellacked right now. S&P. Oh, S&P at 389. I haven't looked at the S&P in the past 2 hours because I was working. But I actually didn't notice this. Okay, Meta at 149 makes sense. Expected that. SoFi is doing well for the day. DNA, where's Glitch Life's favorite stock at 3.1? Guys, I'm probably initiating my position in DNA tomorrow. I kind of made my mind up. The video about it won't be out probably for another 2 days or so. But I just keep getting so much news on this company. There's $1 trillion of Wall Street capital behind it. It's exciting. It's definitely exciting. Tesla's dropping hard. I mean, it went from 307 to 302. It's not really dropping that hard, but it's pretty up in comparison to everything else. ARK is up as well, 44.50 on the day. The biggest news of today obviously was Adobe, and Adobe had I watched a lot of coverage on what's going on. Look at Adobe. They're about to fall under 300, down 17%. The market simply did not enjoy the fact that they paid this much money for a stock or for a company. Figma is an incredibly important tool, but being able to pay this much money is just a little bit too much. And it's rough. Did you read the short seller report? I have started it. Nothing in the short seller report is that troubling, to be honest. I mean, I'm not fully done with it yet. That's why I'm just like, I don't think I'm going to be scared of buying this on the short seller report. I mean, the short seller report means that $1 trillion of equities flowing into DNA is going to go berserk. And I don't think that's the case. I don't think this is like an AMC situation. I think that there's something legit here, especially with the White House announcement that came the other day. I don't know. It seems there are certain short reports that just might not end up working out. Amit the rapper, I appreciate you guys. Someone remixed me. I got to show you guys this. Someone remixed me rapping on the morning live stream today. Like I was saying some words really quickly, and apparently it sounded like I was rapping. It was kind of cool. I'm not going to lie. It's kind of, whoever did it did an awesome job. Okay, let me share it real quick, and then we'll get back into the markets, the stock markets. Okay, here it is. Ready? CEO of Adobe. Adobe's greatest quote from the CEO of Adobe. Adobe's greatest improvement in our ability to create new categories and deliver cutting-edge technology through organic innovation and inorganic acquisitions. Quote from the CEO of Adobe. Adobe's greatest improvement in our ability to create new categories and deliver cutting-edge technology through organic innovation and inorganic acquisitions. Pretty cool, right? Pretty not bad. Quitchlef says, also, I told you that DNA was put in charge of building the U.S. biodefense industry. It's an agency that did not exist pre-COVID. Yes, that is also very true. And the biodefense industry is kind of like a response to everything that's happened, obviously, because of COVID. And DNA being in charge of that, I mean, that's also incredibly interesting and incredibly exciting as well. Adobe had a market cap of 170 billion. They just committed over 10% of their value. It should be hurting. They paid 50 times annual recurring revenue for Figma. However, based on the coverage that I've been consuming, they had to, because Figma was going to eat their lunch because it is such an easy product to use. Think about it like this. The ratio of designers on a product team within multiple products across thousands and thousands of companies, whether they're enterprise or consumer. So like, for example, if you're Palantir, you have a ton of product designers. If you're Facebook, you have a ton of product designers, even if you make fundamentally different products, because every product needs a design, especially if you're working in tech. That proportion is only getting bigger and bigger and bigger. And all of those designers need to collaborate with each other. And Figma is what's creating that collaborative infrastructure, and not Adobe's whatever stuff they offer. People still use Adobe Premiere for video editing, but Figma is there for design. And if Figma ever wanted to expand, I mean, Adobe to me is already harder to use than Canva. I personally use Canva every day. Canva's search engine for photos to build thumbnails is unbelievably useful. Their editing is so simple. Like, I mean, Canva at $13 a month versus Adobe at 30, it's like a no-brainer to me. So, I mean, you got Canva on one hand that's valued at 40 billion. Figma was valued at 10 billion last year in the private markets. Now they're valued at 20 billion. Here's another tweet I wanted to show you guys about the private markets versus the public markets. So, you think we're going into a recession? I don't know, man. Maybe not. Let's look at this. So in public equities, Coin is worth 17 billion, Pins is worth 17 billion, Spotify is worth 19 billion. You've got major public companies that are worth less than what a private company just got sold for. This also may signal that tech might not have hit its bottom yet. Because if we're at the bottom of tech and a company is willing to dish out $20 billion to a startup, which granted, I think you could absolutely justify that. But in this market, can you justify that? Maybe, maybe not. Well, the market doesn't think you can justify that, which is why their stock is tanking 17%. But the fact that that's happening might be signaling that it's definitely not the bottom. But, you know, it could also be signaling that it's just that good of a company as well. President Biden is delivering a keynote speech right now, I think, for union workers. Okay. Interesting. Here's a clip I want to watch in a little bit. Well, we could actually watch it right now. So Altimer's Capital Gernster, this guy is a big venture capitalist. They are now getting dovish on the Fed being hawkish. So let's listen to this.
For Skype and Zoom, but I'm glad we're connected, Scott.
Yeah. It's been a minute too, so it's good to see you. I'm glad you're back with us at this particular time in the markets too. Why don't you bring us up to date on your current view of the markets? As I said, it's been a while since we've heard from you, so I'd love to hear it.
Well, listen, I think you guys have covered it well. It's a period, as Stan Druckenmiller said last week, of peak uncertainty. You know, we were here a year ago and we basically said interest rates are near zero. They need to normalize, which means going back to 2.5% or 3%. Multiples were very high because interest rates were low. Those needed to normalize. And here we are a year forward and they've largely normalized. But the world now is really scared that inflation is stickier than we thought, that rates need to go higher than we thought. So if you look at now what the market is forecasting, even though the one-year break even on inflation is 2.4%, we're still talking about a 75 basis point increase, followed by a 75 basis point increase, followed by a 25. And the market's forecasting that we peak out somewhere around 4.4 in March. And now we have this tension. Larry Summers is saying we're not going fast enough. We need to do another 100 basis points. And Gunlack and Sternlicht this morning are saying, hold on a second here. There's a lag effect. The economy's slowing way faster than you think. Elon was tweeting about the deflation he's seen yesterday. And so I think the risk has shifted to the Fed perhaps over tightening, right? The economy has proven incredibly resilient. The market, frankly, I think is pricing things fairly. But now we're at this moment where we're looking to see, can the Fed get inflation under control to their satisfaction? without rates having to go to 5 or 6%. So that's our view of the world, that you need to have intellectual humility. If you need to make money over the next 90 days, it's a pretty treacherous place to be. But if you want to find great companies that you can compound in over the next 3 to 5 years, we think this is a very fair place to enter those names compared to last fall, that we all know the multiples were quite high.
So if you're worried about the risk of a Fed over tightening, or as you referenced, a Gunlock suggesting to me out in California of the Fed, in his words, oversteering, what's most interesting, I think, is that you told our producers in the conversations ahead of the show, you've been covering your shorts. So your positioning suggests that you see some decent entry opportunities either here or coming up?
Listen, we've had massive volatility over the course of the last 5 months. It's a lot of up, a lot of down, and a lot of sideways movement at the end of the day. So yes, we saw opportunities when companies like Snowflake were trading at $115, $120 a share not long before earnings. We saw opportunities to cover some of our shorts that were down 60, 70%. But we're talking about the ballast here. You know, we take 10 to 15% of our book and we say, listen, when the market is overshooting and panicking and the VIX is spiking, we're going to take off some of those shorts. We're going to add tactically to some of our longs. And on the other side, when we think the market is getting ahead of its skis, the S&P was not long ago at 4,300. We were selling some protection. So, you know, that's a way that we're trying to, you know, move around this volatility. We're not making wholesale moves. You can look at our 13F. Our largest position continues to be Snowflake. And so, you know, but that's a tactical way for us to manage exposure around this moment of peak uncertainty.
So Josh Brown.
Okay, very interesting thing that he just said right there. Gabe in the chat said, why are you streaming the same time as Tom? I stream every day because I do the market close. So I can't, I didn't even know Tom was streaming today. Interesting thing he said, right? Obviously, this guy is a venture capitalist, right? And as a venture capitalist, and he's investing in companies that are high growth tech startups, he is a bit biased towards the interest rates not being as high as they are right now, just like we know Elon is and Cathie Wood is. So, but you can see kind of his logic. But it kind of doesn't matter to me because the Fed is not going to stop. The Fed is going to do 75, and if in October it doesn't go down, they're going to do another 75. Like, I don't think Jay Powell cares. Now, do I think it's going to go down by October given everything that's been coming down like commodities? Yes, but we're going to see. Hi, Amit, did you buy any stocks today? I did not buy any stocks today. I'm going to look at the Kanye thing after we do the market close, but I'm really excited to see that because, like, Kanye is cool. I'm on CNBC all day to see those collaborate together, or not collaborate, but, you know, happen together. That's important. After elections, they will be told to rug pull, pump the markets will roll as well. So here's one thing that's interesting as we wait for the market to close. Okay, and we have our closing bell ready. Ever since 1958, the S&P 500, meaning the market, has given an average return of about 15% on the year after the midterm election year. Right now, we're in a midterm election year. 2018 was down 8%, and 2019 was up like 16%. 2018, we were down because 2018 was a midterm election year. Midterms always screw the market, and the reason for this is because there's basically a lot of instability within like two branches of government that are deciding something, and that creates a lot of uncertainty for how the market's basically who's going to win, Republicans or Democrats. The interesting thing here, though, is that uncertainty is narrative is actually not the case this time around because we passed a bill. Like, we got the Inflation Reduction Act passed. So we passed something right before the midterms. There's not that much like, oh, if the Republicans win, this will happen. The Democrats win, this happen. Like, it's kind of just going to be stale, whatever side wins, unless there's a massive takeover by one side or the other. Then things will actually change. But from an economics perspective, I don't even know if the Republicans will get enough seats to like pass more tax cuts. And we're still under Trump's tax plan, technically, correct? I don't think I'm wrong on that. So I don't know how big of an impact it's going to have. But historically, 2023, if it matches the historical trends, we should have a monster market. I want to see if I can pull up that chart later to show you guys the chart that I'm referencing. But we should have a huge market in 2023 if it holds true to what's happened since 1958. But as we've seen with the 2-year, 10-year inverting, like, things are not going as they have historically, which means we might be in for a different world in 2023. All right. The market on September 15th, 2022 at 4 p.m. has officially closed. The stock market is closed. Let's check on some stocks, how they closed. Tesla 303 did pretty well today. Palantir 801. I love that 8 close. Love it, not bad. Apple 152, DNA 3.125, Amazon 126, AMD 76, Nvidia under 130, Meta 149.55. Let's get this good stock. I was going to say like good baby. That didn't make sense. I always have to say bad baby, but you know what I mean. Let's get it to 140 and then I'm buying. Let's get Google down to 100 and then I'm buying. Where's Google? 103. Let's get him down more. Let's get him. Bitcoin under 20K. Under 20K. All right. Let's look at the Kanye West clip. I really want to see this. Amit, I would like to have a live debate with you and Gabe. Let's do it. Glitch Life. I'm down. You could probably come on tonight for late night stock talks at 10 p.m. if you're ready. I know Gabe will be there, so you could probably be there. Chris says, I'm buying, deflation incoming faster than most people think. God, not that bell. Chris, the bell is what people like. Okay, Chris, you're buying. Interesting, Chris. I would like to know more deeper on your thoughts for why you're buying. We might have to do a podcast. Well, we'll talk about it tomorrow on Friday on Palantir Weekly. By the way, guys, you know there was an Alex Karp interview that came out this morning. It literally came out this morning. It was from his Swiss whatever thing he did. It was like such a 4K video. It was so good. Someone tweeted it to me, and I was watching it early in the morning, and I was too lazy to get up and download it because usually I download all the Palantir content, then I do whatever I want with it. And 3 hours later, it was taken down. And I was so upset. I was like, oh my gosh, this was such a new interview. He was talking about the philosophical, individualistic narrative about Silicon Valley versus Switzerland. They have 40 employees in Switzerland, so that's why he was there. But I wasn't able to get it. Hopefully, they're going to upload it in a couple of days or something. But it was pretty interesting. ER Pro, what's up? What's up? Happy you are here. Karp is on the marketing grind. Absolutely. There is so much content here. Amit, if you are a long-term investor, why are you worried about $3 to $4 a share on Google? Because getting it at 100 would be cooler than getting it at 104. It's 100, it's $4. No, honestly, it's just because I'm still skeptical about the market, and I'm just like, well, if it goes lower. But you're right, I should DCA. Like, I get it, but like, I'm also mad I missed the bottom on June 16th. So I'm like, I kind of want to make up for that. All right, let's look. This is the Kanye. For those who don't know, Kanye West owns a part of Gap as per his deal, and a little bit of Adidas. I think he obviously has some equity in it. He has been really upset. He's been tweeting or not tweeting. He's been Instagramming his frustrations with the company that they're not giving him creative control. And so he's lashing out. This was an impromptu appearance on CNBC. So let's watch this together. I have not seen this yet. All right.
A surprise guest for you is Ye himself. It's good to see you. Thank you for joining us.
Absolutely. Thank you for having me.
So talk to us about what happened here. Why are you terminating this deal with Gap?
Well, it was always a dream of mine to be at the Gap and to bring the best product possible to the masses. And I always talk to them about doing products for $20, like the best product in the world, designed at the same level of the top fashion houses in the world at $20 for the people. And so we went through 3 years, and, you know, obviously there's always like struggles and back and forth when you're trying to build something new and integrate teams. So we designed an entire collection, and actually I wasn't able to set the actual price that I wanted for this collection. And then they actually took one of the
Okay, so first reason Kanye West says he cannot set the price on his products. Two things for me right here. Number one, the agreeing with Kanye's side is like, okay, if they gave you this partnership, you should be able to say what price you want. The business management side of me is like, they are a multinational corporation. They have to look after profit margins, and there may be some things they're not taking into account for why prices need to be the way they need to be. So there's two perspectives right there. Also, I'm sorry, guys, about the camera quality. The Wi-Fi is bad. It'll get better in a second.
The shirts and sold it for $19. So didn't price my stuff. Priced my stuff at like $200 and above their whole price point normally, and then did the exact shirt for $20. Also, they did pop-ups and I signed on with them because they had in the contract they said they were going to do stores, and they just ignored us about building stores constantly, and it was very frustrating. It was very disheartening because I just put everything I had. I put all of my top relationships. I went and got Demna, the head designer of Balenciaga, which is one of the hottest brands in the world, to come. He does couture, and with that relationship, he ended up working on a Gap collection for me. There are a lot of things, colorways that I didn't approve. There's a lot of places that the product went to, certain sites where it was like they were just dog and pony and the idea around town. And sometimes I would talk to the guys, the heads up, the leaders, and it would just be like I was on mute or something. And they totally, our agenda, it wasn't aligned. And I know, my family, we're Garmentos. My family, we made the first Louis Vuitton bootleg jogging suits. When they used to confiscate the bags at LAX, that's actually literally my family that would cut up those bags and make jogging suits. We literally would make cross colors. Yeah, this is because people always think of things like a celebrity. This kind of, I wouldn't have been so influential in clothing language. I like that, but I like the word language better than aesthetic, because the language is a base. Aesthetic is just a style. It's a language that me and Virgil and Demna and Jerry Lorenzo and Matt Williams brought in streetwear, in this Marc Echoes complex idea of what it is today, what high schools look like today. And everyone knows that, I'm the leader, I'm the king, right? So a king can't live in someone else's castle. A king has to make his own castle.
Okay, so here's my basic thoughts on this. It's very simple, okay? Very simple. Kanye West controls the attention of the masses. If he makes a water bottle and puts his name on it, people will buy it. He likes clothing, right? There is no reason him as a creative can't figure out the business side of it, partner with people internally, not multinational corporate brands, because you're not going to get the leverage you want with them, and build your own shit. It's just that simple. And this is what Kim Kardashian's doing, ironically, with her PE, a private equity firm that she just raised $200 million for. It's very simple. She controls distribution to about 1 billion people, her and the Kardashian brand. They can make anything and they will sell it. The product has to be good, but they will sell it. Why can't Kanye do that? Kim's Skims brand is her brand. It's not a partnership with some other company. And that's worth $3.2 billion. There's no reason Kanye can't make a brand called Ye and literally have factories inside of the United States and build the clothes yourselves. It's very simple to me. Very simple. And Kanye should do that. And that brand would be really big. We are entering in a world in which creators have all the leverage. Creators have all the distribution. And if you have all the leverage and distribution, and you can build good, what's happening with Mr. Beast? He didn't partner with Hershey's. He built his own chocolate bar. You could figure out how to make some chocolate. Hershey's is not that special, but the attention needed to sell that chocolate obviously is what matters a lot more. So, I guess that's kind of my take on that. Let's see what's going on in the market world and see what people are talking about on CNBC. So let's go. This is an interesting one. Apple will decide what valuations are. I've been talking about Apple a lot for the past couple. I have a video coming out as soon as this live stream ends about Apple, and I think you guys will like the thumbnail. My Tristan just made it. Oh, you guys! I got to show you guys the thumbnail because you guys are in the late night stream or in the market open. Whatever we call this thing. Ready? You want to see it? Look at this. Apple is now the most shorted stock in the world. So my editor just made a look at this. Tell me that thumbnail is not. I don't know how the video is going to do, but the thumbnail is pretty good. Okay, let's listen to what Apple's valuations are going to be like, or how Apple's going to dictate the market's valuations.
1980 and 81, inflation was out of control. Paul Volcker crushed it, and 1982 became a space shuttle-like liftoff for equities.
Yeah, no, I think that when we look at what happened Tuesday and we take a longer term view, even a year out, does it matter if the Fed hikes 75 basis points or 1%, right? Like if we're 18 months out, we look back and say, oh my God, that changed everything? Probably not. I think the big question is if March and April of next year, are we seeing inflation year over year with a 4 handle, or are we seeing inflation with a 6 handle, right? And that will dictate what the discount rate of the markets are and what valuation are. So not too concerned the short term just because of one print. I think the market kind of overreacted from that perspective. But inflation clearly matters, and we'll just have to see what happens next.
It does matter, David. And rate hikes matter. But I'll quote another historical period. And you were probably just getting started in the business in 1994. The Federal Reserve raised rates by 2.5%, what we'd call 250 basis points. Super aggressive. In 1995, the Dow rose 33%. There are some historical analogies for this time and where stocks may go?
So we think so. We think that when inflation breaks from very high rates and goes lower, stocks generally do quite well over the next 6 to 12 months. We think that's going to be the case this time. We definitely see inflation breaking. It's not linear. This week's CPI numbers were disappointing, but we think the general trend is lower. It's going to be next month, the month after that. We think the Fed can be less hawkish next year than is currently feared. And the economy is actually in better shape than many think. A number of companies presented at conferences this week, and the outlook was generally pretty favorable. Logistics problems are getting better. The banks spoke, and they said their business was good. Consumers were good. Businesses were doing well. So we think there's a lot of good out there, not all bad. We'd be buying this dip pretty aggressively.
Well, David,
we do think 6 to 12 months.
I'll follow. No, it's okay. I'll follow up with you on that point. You made a pretty good bull case, right? Consumers been strong. Earnings have looked good. Then what the heck is the market doing?
Well, right now, the market.
This is the good question, right? Earnings are good. We understand Apple is still going well or innovating or whatever. I guess you could argue that. But what's the market doing? Why is the market not valuing it the way they need to be?
Is obsessed with the Fed. They're obsessed that inflation didn't break this week. And they think the Fed is out to destroy inflation. And if the economy gets destroyed along the way, so be it. We don't think that's the case. We think the Fed wants to control inflation. It's easier for them to talk about controlling inflation and talk about raising rates than actually raising rates all of next year. We don't think there's any mileage in them declaring victory early. We do think inflation's breaking. We think by the end of the year, the Fed will be a little bit less hawkish. And we think the market's major fears probably won't come to fruition. If you look at the stock market on a business by business basis, there are a lot of great companies at 12 to 14 times earnings. Historically, that's been a very good time to make money. So, we're feeling good, and we'd be buying stocks into this dip.
Does a lot of it, Andres, have to do with your time frame?
Absolutely, right? So if your time frame is 6 months, you kind of have to make a bet on what you guys were just mentioning. If you're looking 5 years out, you have to think about it from a perspective of expected returns, which is you even have an option. I mean, are you going to sit on cash right now, right? Making 50 basis points when inflation's at 8? Or are you even going to buy a bond, which is still yielding, 2-3%? So from that perspective, it really does matter what your time frame is. What we're, our big recommendation, actionable steps is rebalance. Know what your portfolio should look like and use this volatility to rebalance.
Well, Apple is in a very precarious position. Let me share my screen right now. Someone said there's too much sugar in soda. I'm not drinking soda. I'm drinking beer. The beer just is called Coke. So that's what we're getting done. Anyway, Apple. No, I'm just kidding, guys. Yeah, I'm drinking some soda. Okay, Apple 152. This is really interesting. I think the market's trying to really think about how do we value Apple. 56 on the RSIs, approaching overbought when you get close to the 60s. We saw it was above 70 for the majority of time of 2020, up until 2020 till basically 2022 March. It was above 70 on the RSIs, and it was somehow maintaining its valuation. It finally, cracked at some level. When I think about owning Apple, right, and if I forget the technical perspective, if I think I take a Warren Buffett type of view on it, when the market gets bullish and the macro comes back, Apple is the market. One could argue, like Tesla is the market, and getting Apple at these prices, you could argue is cheap. Like, do you believe in the growth of the iPhone and the services and the potential VR stuff? And like, personally, to me, I'd rather take that money and put it into something like SoFi, because I believe in their banking infrastructure actually being facilitating the ability for new fintechs to process. One thing that's important to understand about SoFi is Robinhood, which is one of many fintechs, runs their entire payment processing APIs on top of Galileo, which is what SoFi owns. When I found that out a couple of weeks ago, I was shocked. I was like, wait, so their biggest competitor is using their product to be able to facilitate transactions for payment processes, which is the number one thing you need to do if you're a fintech startup. Like, just like regular startups need compute from AWS for data storage, fintech startups need regulatory approvals and APIs, which are application programming interfaces, to be able to process payments because they are fintech, right? They literally process payments all day. That's how their startups operate. So SoFi is really exciting to me at that point. And the 10x there is way better than I think way easier, even the 5x than Apple, right? But Apple's obviously safer. But SoFi is starting to look very safe as I do more stuff. Amit, what is your Apple? If it goes back to 129, which was its low, then yes. But that only happens if the market collapses. If the market doesn't collapse, then that's not going to be the case. Okay, I want to show you guys a chart real quick. Hold on one sec. I'm pulling up a chart. Perfect. Okay, here's a video I did on January 12th, 2022. Okay, you guys are going to laugh when you see what I look like. That's what I was wearing. You don't have to laugh in front of me, okay? You can laugh privately, but I don't know why I was wearing that, but I was wearing that. It was cold in New Jersey. Okay, here we go. Let's look at this chart. So S&P 500 index pullbacks during a midterm year, which is what we are in right now, okay? That's what we are in. If you look at the year from 1950 all the way till 2018, okay? The intra-year pullback on the S&P 500 averaged 17.1%. Every single year. Last time was 2018, 2020. That's not on there, but 2018, when we had a midterm year. The return a year later, okay? The return a year later. I'm sorry, my face is right there, but look at this at the top. 30%, 43%, 36%, blah, 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 blah. All the way we go down. The average for that, okay, I remember the number, even though we can't see it because the box is in the way. It's 33. It's 33%. The average is 33%. Actually, hold on. This is a Twitter. I'm just going to pull up that link right now. Let's do that. I can just copy and paste the link right now. Twitter.com/Ryan Detrick /status. Okay, we got status /148,075. I appreciate the patience with this. This was not planned. 409. It's actually kind of funny. Someone needs to clip this. 409-368. By the way, Casey Neistat's back on YouTube. 368-9876. 9876. I said that because of 368. 485. 485/photo/1. Boom. I got it. Okay. So here's what I'm going to do. I'm going to share the screen. And this is what we got. Okay. See, I was correct. It was 33%. I knew it. So this is an incredible thing to look at, right? This is absolutely incredible to look at. Every single year after the intra-year pullback on the S&P, we had a 32.3% gain back. So in 2018, we had a 19.8% pullback on the S&P, which is pretty rough. And we had a 37% gain a year later on the year after. So that would be 2019. So if this year we're ending, the S&P was at 478. So I don't know what we end this year. 10% down, maybe 15% down, maybe a little bit, maybe 10, maybe 8%, whatever it is. Then we're going to be up theoretically on average. Again, if the average plays out, 32% next year, which means it would round out to be average. Let's say if we're 15% down, we're up 30%. You make up the first 15%, you're up 15%, which would put the S&P kind of around the same, either close to 500 or the 490, 480, that same level. Tom Nash just said he's going to be 100% cash next year, not buying anything next year. Interesting. Well, so if the market rallies and he buys everything he needs to buy this year, then he's going to be in a good situation as per this chart, right? If the market crashes, then obviously it's good not to buy. But, well, no, if the market rallies and you didn't buy, then it would be a bad thing to not buy, at least now or at least early in 2023. It depends on when that 32% average rain actually comes. So we would have to see, but I think this is interesting data, right? It's really important to kind of look at that and sort of understand how the market would be reacting. I think this year is different though, because now you have these interest rates. Now you have midterm elections. Now you have the Fed potentially going up to 4.75. Now you have a lot of people who are hawkish or are dovish. Now you have inflation. We didn't have inflation, at least in 2018. It was like 2.4%. Now it's at 7. Now it's at 8.1, 8.3. It's a little bit, history might not be the same. I'd buy Apple just because of its free cash flow, but it's way too much over of the S&P 500 and index funds. If there is a big crash, you could have a snowball effect. I agree. Absolutely. People are like, what should I do on the green screen? I don't know. We got to figure it out. What do we do on the green screen? But I think that was important. Okay, let's go back to the markets, and then we'll check out what CNBC is saying. So SoFi 640, Palantir still up above 8, Apple 152, DNA 3.1, Tesla 303. Yeah, nothing changed. Everything's pretty much the same. If anyone bought anything today, let me know in the comments if you bought. But Chipotle is at 60 on the RSI, by the way. So I never got Chipotle. I never knew why they were so expensive, but I guess I missed out on their run. Okay, so that's pretty much it. Obviously, the big news of the day was SoFi. Glitch Life. Why are you saying you're about to go 20% margin when you got margin called like 10 days ago? Did that not scare you from not using margin anymore? Because if I was you, I would be a little scared at least, right? Like a little bit. Because that's a lot, in my opinion. Margin's just always been scary to me, bro. Like I don't always want to do that. Okay, let's see. Let's see this. This is Josh Brown. Always good to talk to him. The rallies we've seen remain counter trend. This is probably the last thing we'll see. And then we'll end it there. Glitch Life says, no, I am not scared. I got margin call, but that was an accidental on a bad trade. Okay. That makes sense. Did you buy Adobe? I did not. I don't have that much conviction in Adobe to buy it.
Because the stock's down about 7% intraday from Monday's high, right? It was 164. It's at 152. How concerning is that sign in and of itself to where the market may be going from here?
Well, look, mathematically, it's an important weight in the market. And just because the stock is not acting well doesn't mean the rest of the market can't advance. But given Apple's size and given its importance to so many different strategies, styles, indices, ETFs, obviously it's something that everyone has on their screen. It's the most widely held, probably most important stock on the planet Earth. But I think the bigger issue here is the rallies that we've seen, including the historic rally off the lows that ended in the middle of August, really remain counter trend. And, I think a lot of times we make this harder than we have to. The NASDAQ 100, the triple Qs have been in a bear market all year. The NASDAQ 100 has been below its 200-day moving average for 113 days in a row. It's had 4 episodes where it's broken above that 200-day moving average and failed all 4 times. So that's obviously trading information, right? Being below a 40-week moving average for 36 weeks. Okay, maybe more interesting to traders and investors, but the takeaway for investors should be that there's no rush to be buying into NASDAQ stocks. There's no reason to expect any more than a bounce when they're rallying, so long as we're below this long-term moving average. It just doesn't seem that complex to me, and yet people keep getting surprised by it.
Shan, talk about a surprising stat. According to S3 Partners, Apple's the new #1 short in tables, in the short interest league tables. Tesla was the #1 for 864 days since April of 2020. Apple recently recapturing that crown. I'm wondering that's clearly a statement of some sorts on where overall sentiment is in the market. But again, people betting against what has been the most loved stock in the market for quite some time?
Well, not only is it not is it only one of the most loved stocks, right? We're thinking about it in terms of something that Josh just brought up. It is continued pressure on technology stocks. It is continued pressure on the perception, not the reality, but potentially the perception that large cap tech stocks are going to continue to suffer as expectations for an asymmetric increase in rates happens in the first quarter of next year. I would argue, too, that the intersection of concerns about the U.S. consumer and perhaps even more importantly, the Chinese consumer, as we're waiting to exhale on when Chinese consumption is coming back, is where Apple sits in that intersection, at that nexus of all of these concerns and considerations. The other challenge here is that you could just be seeing people take exposure off the table. If I'm looking at my standard, to Josh's point, very widely held stock, looking to take exposure off the table in U.S. large caps in general, you've got a couple of choices, right? You've got Apple, got Microsoft, Google. You potentially have Tesla. It's nice to see that people are taking that short off. Maybe it's because Musk isn't buying monitors for his employees to come back and use. Not sure. But I think this is where we're seeing the intersection of multiple trends. I don't necessarily think this will end. I think there will continue to be some pressure on tech stocks. And to Josh's point, haven't said that there's a big rush if we're looking at coming into the middle of October.
What's the time? All right, that's it. Some of you are talking about in the chat that you are buying Adobe. I agree. Adobe probably has a monopoly in their space. Definitely agree with that. I've never had such a personal relationship to the company for me to buy it and be like booey, rah over it. But I could understand that Adobe is obviously a market leader in their space, not really any main competition. They were a $700 stock at one point, and now they've gone down to a reasonable valuation. You could argue $148 billion market cap, doing $13 billion in ARR. So I think that's a price of sales of like 8 or 9. But I don't know. Adobe doesn't excite me. You know, if Adobe cost me $300 and I could buy 50 more SoFi shares with that, like, that's more exciting. Or 45 more Palantir shares. So, yeah. I think that's pretty much it. The market's being the market. I'm coming out with a video literally 5 minutes after this ends. Nothing too crazy. Big news was Adobe. Apple is going to be something we monitor for a while. Tesla's doing phenomenally well. S&P, where's the S&P ending? The S&P 500 is 390. Okay, so we're ending at about 390. Yeah, overall, not a horrible day. I mean, it's worse than yesterday, so I guess we're going to see how this continue to go further as well. You're killing me with SoFi and Palantir a bit, but you're cool. I love you trading with a dummy. I just disagree on some stock picks, but I still appreciate you. I would look at more into, I would definitely look into Palantir. If you are not invested in Palantir at these prices, I don't want to demonetize myself, but I genuinely think that you're not a smart person. I really do believe that. At these prices, if you don't buy Palantir, because, and this is a video I'm going to come out with later as well. Me, Coach Rep, and Chris, we had a conversation about why it's so good to have a Palantir-focused channel. And one of the reasons was it forces a lot of these geopolitical, philosophical, macro-level discussions. Now, does that mean they don't have sales problems and execution risk, all that stuff? Yes. But being an investor in Palantir, I mean, just per yesterday, looking at the interview, it forces you to question the relationship that China has with the United States from a globalization perspective and what that means for companies that need to defend their sovereignty and their Western values and freedoms and how that can be compromised. Like, these are all things that I think need to be understood. And Karp was talking about organizational democracy is one of the most crucial things that only software can accelerate. So if you know about that stuff and you're not buying at these prices, again, everyone has to make their own investment choices. But if you, like, I personally think that is a asymmetrical risk that you bet on. Palantir is a $15 billion company. Figma was purchased today for $20 billion. Figma helps people make better product designs. Palantir is helping Ukraine not get demolished by Russia. That's my point, right? Like there's a little bit more nuance here that we have to understand. I'm buying at 5 and 6 on Palantir and only around 100 shares, but admit I told you what I do for a living and how I can get behind Palantir. Yeah, well, to each their own. Understand it. Totally understand it. So it might go to 5 and 6, by the way. It might go there. It might go low. We got to see what happens in the macro. All right, everybody. Thank you so much for joining me. I appreciate it. Video coming out in a little bit. I'll join you guys at late night stock talks at 10 p.m. Link to register for my startup in the description. Would really, really appreciate everyone checking it out and just seeing what it's about. We're trying to change the way audio gets discovered. So would appreciate any feedback by anybody. Thank you guys so much. I will see you later today. Bye, everybody.